Alright, y'all, welcome to day 9 Introduction to Technical Analysis for Swing Trading. Technical analysis is the study of historical price and volume data to forecast future price movements of a stock or asset. As a chart we were looking at. Unlike fundamental analysis, which looks at a company's financial, technical analysis focuses purely on market behavior. So when you're able to read the candlesticks and read chart patterns and read volume, that's the technical asset of it. Using charts and indicators to identify trends and patterns. Swing traders use technical analysis to find the right entry and exit points based on price action and technical indicators. Typically holding stocks for a few days to a week, or a few days to a few weeks, so long weeks, so long months, whatever. Price charts. So you have line charts, you have bar charts, you have candlestick charts. Now we look at candlestick charts. The line charts are like the ones you see like on Yahoo Finance. So we quickly pull up Yahoo Finance. This is a bar chart, right? This is a line chart. Sorry, this is a line chart. This is a candlestick chart, right? So these are candlesticks. As you see, the candle, you got the wicks. The wicks are the little skinny lines. That's the wicks. Candlestick patterns are particularly used for swing traders as they can indicate potential price reverses or continuations. Now, I like the candlestick patterns for sure, like a bullish pattern, like a hammer. I use hammers and I use shooting stars. I don't really use engulfers like that. I don't really even look for them, to be honest with you. You can. I'm not saying they don't work, but I like hammers and shooting stars to keep it simple. I either need to see a nice close, so I look for a strong candle like this one. This is a nice average strong candle. Now, when you get this extended candle, see how all these candles are pretty average, and you get this long one. This is usually a sign of exhaustion. As you can see, it came up, and then after that, the price started to fall down after that. So when you usually see a long candle after that, like, all right, these are average candles, average good candle. When you see this, it's not long before that price starts to fall back down. Then it works for the reverse side too. So see these are decently bigger candles, but you see this big exhausted candle, that means we get a reversal coming in. And you usually see these like at the top of like here, especially this one. Average candles, you see this long wick, exhaustion, the price came back down. Average candles, we get a big exhausted candle up, and then a big exhausted candle down, then the price fell down normally. So as you can see, these above average candles usually associate a reversal. The reversal is usually near. It's 100%. 100%. Like, look, average candles, exhaustion, fell. You can look at this all day. Yeah, they're everywhere. So that is the power of candlesticks. Let's lock back in. Key technical indicators for swing trading. Now we was looking at the 200-day EMA, so we're looking at that. Simple moving averages and exponential moving averages. The EMA, the only difference between the EMA and the SMA is that the EMA gives more weight to recent price movements, making it more responsive to price changes. So simply, if we was to come back out of here and we was to go into here, they're going to be slightly different now. They're going to be super slightly different. So this white line should be the 200. So as you can see, the 200 EMA is usually better for trading because it's a little bit more sensitive. But if you're looking to hold your swings a little better and longer, then you would click off this, and you can see that this would have held a little bit better. We had a rejection here, rejections here, so that would have held a little bit better. But the trading aspect, you usually don't get as many signals. It just depends on how you want to look at it. You can hold the trade for much longer, much longer, super duper longer. So it just kind of depends on how you want to use it compared to like the EMA, which would have been, it's pretty similar, but the 200 you do get less signal because it doesn't move as sharply. So that's pretty much it. That's the difference between those two for the most part. And you got RSI. With that RSI in the last video, that's just like we can actually just leave those on the chart. So let's pull up the RSI too. We can pull up the. We'll leave those bad boys on the chart. The beginner trading starting pack indicators. The starting kit. That's the trader with no badges. No badges. Oh my God, trader, no badges. Yeah, so the oversold here, but it kept running up, and you would have sold, but you kept, it would have kept running, and it told you sell here too, but it kept running. So I just the trader starting pack, ain't nothing wrong with it. But it's crazy how see, the whole time I'm in a short and I write it down. Let's see. I would have rolled this down from here to here. So I wrote it down 41%. So I would have got a 41% return. But the whole time you in here, You in here buying here, then you're selling here, then you're buying, then you're selling, then you're buying, then you're selling. I don't got time for all that. We're not trying to do all that. Why are we in a downtrend and we're buying here? Why are we buying here? So that's just, now they do say to filter out certain, but if I just can catch this whole move and just eat my chips and eat my cereal, I don't even like cereal. I don't know why I'm saying that. I barely eat cereal. But if I just eat my hot chips and my praline ice cream, you know what I'm saying, and eat my steak and eat my salad, you know what I'm saying, eat my watermelon. I don't know why I'm talking about eating a bunch of food here, but we just chill. We just let the trade ride out. We just save ourselves a lot of stress. We just save ourselves a lot of everything. Just look how just look. Just look. You know what I'm saying? That's so easy. That is so easy. So yeah, man, that's it. That's it. Let's move that drawing out of there. Let's get that out the way. So yeah, that's pretty much it. That's the RSI and that's the MACD. Looked at both of those indicators. Let's get to the next one. Support levels and resistance levels. And we have breakouts. So let's look at support resistance levels, right? Support levels, price bounce upwards, resistance levels, price bounce downwards, acts as a ceiling, and breakouts when price breaks above and continues going. So let's give y'all an example of all three. All right. Now, support and resistance levels can be diagonal. A lot of people don't actually teach that, but that is the truth. So if we get a level here, and then we get the level here, like here. As you can see, this wasn't the best level, but I know some trend line traders, so let's, like, if I hide this, right? So all you need is two bounces. A third bounce is really good. Sorry. So if we try to look for a third bounce, so let's, like, here, it's perfect. All right. So this is a downtrend. So once we found this downtrend, boom, that's a support level. So it hits this and it bounces down, and it hits this and it bounces down, and it hits this and it bounces down. So we know that this is a strong downtrend, right? So we're going to wait for the moment that this breaks out of this downtrend. So the second it closes above, we're going to take a trade. And as you can see, this is a beautiful trade. We'd have put a stop loss here, and it would have ran into the sunset, basically. And you just trail your profits, bob, and you're making a lot of money. It's a lot of money. At the height, I got to do the returns. I can't help myself. Y'all got to deal with me. All right, 29% return, perfect. You know what I'm saying? So that's how you look at that, right? That's trend line support. So now we can do support, right? So as you can see, we drew it down here, but what happened? It respected it all through here. It respected it here. It even bounced off into the upside here. So that's a breakout here. Breakout here, respected it. It respected it all along this line. Look how beautiful to the tip. It's beautiful. That is gorgeous, right? Now we're gonna look at the support level. So that was a resistance. This is diagonal resistance. You can also have sideways resistance, right? Because we're not gonna leave out y'all sideways people. Sideways resistance. Simple as that. The price came up, it bounced down, came up, bounced down, came up. Broke out a little bit, but it was a false breakout. Then it broke down. It was a beautiful breakdown. As you can see, the candle it lets you know that it was about to run. Came and it bounced up, tapped it, bounced up. It held, as you can see, the wick held right above it on this candle. Then it gapped down and it ran. So as you can see, that's diagonal support. I mean, that's diagonal resistance. Okay. Now we can look at diagonal support. We're gonna grab something. Let's do it here. Let's do it here. It's nice and simple. Nice and slow. Boom. All right. We tapped it one time, two times. Just, I guess, played with it here. Played with it here. Respected it here. Respected it here. Respected it here. Respected it here. Came up. Literally dropped right back down. So as you can see, it couldn't hold that point at all. So that's diagonal. Then the last, that's diagonal. Actually, and that's resistance turned to support. So as you can see, resistance, the price couldn't get above. So it tried to get above, and it came back down. Try to get above, came back down. Try to get above, it came above a little bit, came back down. Try to get above, boom. And eventually, as it kept fighting that line, and eventually it broke above, and it tapped it. And it tapped it again. So as you can see, that's how important it is that support can actually be turned into support from first being resistance. So that's all. It's just an area where prices, people are interested in price at, interested in either buying or selling. And then diagonal support, and I'm gonna leave y'all alone, I promise. Come from here, to like here. As you can see, we touched 3 times. That's all we needed to do. The better, the more it touched, the better. But 3 times is perfect. 3. So 1, 2, 3. Touch the 4, charge the fit. The second it broke below. Oh my God! Why did I do that? Back. Yeah, let's actually lock it right quick. Let's lock it. Okay. So as you can see, the second, so I broke below as a false breakout. False breakout. Obviously, that's why I don't trade this strategy, but it's still a thing. Sell, you actually would have made you gotta hit your target here. If you was doing, if you was using the target that I like to use. Came up again and it bounced down. This was a bad close. I wouldn't have taken that. The rejection here, you could have got like your little doji, little shooter kind of little mix of a baby here. Could have shorted here, and then after that, it never closed above again. But like I said, it continued to. So you know, I just I don't know. I don't like it, but that's the thing. It's a thing people like to use. So you know, but that's really important. It's just like I don't trade like that, but people trade like this and make money. So you know, whatever works for you, as long as you're making money, I don't really care what you do. All right. And then last but not least, combining technical indicators for trade confirmation. Confluence is the idea of using multiple indicators to confirm a trade setup, increasing the probability of success. Yes, yes, yes. All right. So if a stock hits support and RSI is oversold zone, and a bullish candlestick appears, bullish means a green candlestick. This confluence may signal a higher probability of a price reversal. Similarly, if a price breaks resistance with a high volume breakout and then a MACD is showing bullish momentum, this would reinforce the idea that the stock might continue moving higher. Okay. And risk to reward ratio is also key. Okay, so before we end it out, let me give y'all a good example of that. Okay. So if we want to create a trading strategy, yeah, remove that. Okay. A trading strategy out of thin air, right? Let's say, all right, Zay, we only wanted to buy stocks that came from undersold, and then it turned green on the MACD. So it was undersold, and then people kept selling off, but the second it turned green, we wanted to buy. All right, so right here is a perfect example. Undersold, wait for the turn green, we buy here, and then you could either sell here, which would have been a better strategy than wait for it to go all the way back down. So we buy here, and then we set the nearest swing high. So we buy here, set the swing high with a profitable investment, right? A profitable trade. Another one here. We got the undersold, wait for the turn green, so we bought on this candle, and then we sold at the swing high. I mean, as long as we had a good stop loss, we would have made money. No, we actually wouldn't have made money, so that would have been a loser trade if that was our strategy. Then we can also do sales too. So let's say we wait for it to get oversold. Overbought. So we went overbought, and then we just wait for the sell signal. The second they got the sell signal here, we would have sold here, and we would have lost money. So that's why I don't use this trading strategy. But that's a trading strategy to add up confluences and possibly make you better. But we're not doing that. No, we're not doing that. Don't even waste your time with that. Please don't. All right. But that's day 9. Appreciate y'all for tapping in, man. Y'all made it to day 9. Oh, y'all really want to get y'all life. I'm proud of y'all. Y'all trying to get y'all life together, man. With the market too. See y'all in the next.